When you talk about climate change and when you try to convince some of your investors that it's a good idea investing in green bonds or climate change, what do you need more in 2018 to make it possible?
Actually, we have taken a major initiative. We are launching a major green bond fund dedicated to green bonds in the emerging market space with the IFC World Bank. The idea is to unlock private funding towards climate-related projects. The problem is very simple, actually. You've got, on the one hand, a long-term excess of savings parked in low-yielding securities. On the other hand, basically unfulfilled needs for investment. So it's a matter of plumbery. You need plumbers. We are plumbers. And we've got two problems to solve. One is the capacity to invest in the emerging space, and specifically to manage risks attached to emerging markets. The second is the capacity to invest in infrastructure projects. It's a question of access to assets, issuance, origination. And the solution is basically to bring the best of two worlds, this partnership between private and public sectors. The private sector, Amundi, is basically bringing to the table capabilities in emerging debt management. On the public side of the equation, the IFC will brings basically a 10% first loss absorption mechanism.
But this is also true for the developing countries.
Developing country
but
in the emerging.
It's more difficult in developing countries.
Yeah, actually, but it's critical to be able to channel this excess of savings at the world level towards the developing world, and this is a practical initiative we've been taking, and we are using banks as intermediaries basically to facilitate the origination and the issuance, and on top of that we are putting ESG filters on the green bond structure. So this is a very practical example of an initiative.
What kind of returns can we expect?
We are in the region of 4% type of returns, actually, and we are creating a market because it's a unique initiative. We are creating a market with impact and offering investors yield 4% with an impact. Yeah. So this is an example.
Pascal, one question also on European stocks, and then my co-host, Guy Johnson, will jump in. But when you look at European markets, you're expecting a renaissance in European stocks. Are you worried about the high level of the euro actually hurting that renaissance?
I'm not that worried about the euro on a trade-weighted basis, where I feel pretty much comfortable. Actually, my conviction is the following. Brexit and Trump have brought uncertainties. Europe is building momentum on certainties, actually, and there we are in a sweet spot. I can mention the cyclical recovery, a credible path towards reforms, the fact that the political uncertainties behind us, thanks to the election of Mr. Macron, we've got leadership back in the landscape with momentum building in terms of reforms or paths towards reforms. There is still a valuation gap relative to the rest of the world on the equity side, and dividend yields are in a, I would say, attractive area.
Pascal, Guy Johnson also has a question for you. Guy.
Pascal, good morning. Do you think that green bonds will look quite as attractive once we end the QE phase that we're currently in? US 10-year currently yielding 2.3. You're talking about 4% on green bonds. As rates start to rise in the developed world, does the argument start to dissipate a little bit on the green side?
I don't think so. Actually, there is still room in terms of strategic asset allocation on the institutional side of the equation, basically to put money at work in that space. Because when buying green bonds in the emerging market space, you are basically killing various birds with one stone. Actually, you are basically putting money at work in the emerging market space. On top of that, you are capturing an illiquidity, a liquidity premium We are talking about a relatively sticky investment in the region of 7 to 10 years area. And the removal of the QE shouldn't, in my view, be a problem for this type of investment.
Can I just bring you back to some of the issues you were mentioning as well? Can I just ask you a question about volatility? Global markets, you talked about what's happening in European equities, but global markets, whether they're fixed income or foreign exchange or equities, have seen volatility incredibly low over the last period. Do you think we are now coming out of that phase? And I'd be curious to know what you think kind of that means for investment strategies like risk parity. Are we starting to see a new era beginning to emerge next year, do you think?
I don't like, generally speaking, the concept of new eras, actually. I think that markets are behaving, looking at volatility, are behaving as if all the unknowns were knowns, which is basically wrong. Actually, I don't buy at all into this Goldilocks story where volatility would stay structurally low moving into a new regime. Actually, I think volatility will be back in relation probably with monetary uncertainty. This is one reason. Geostrategic uncertainties, and there are many around. So I wouldn't be surprised to see volatility striking back with a vengeance moving into next year.
Pascal, I think overall earnings growth in Europe is expected to be around 8% next year. Given the kind of growth that we're talking about and given your comments, do you think that's too under-optimistic, not optimistic enough?
I think I do believe we are basically embracing a sort of European renaissance, and Europe is definitely back into the global portfolio, starting from a very underweight positioning. So there is room to catch up in the global portfolios. I don't see many reasons basically to see this path towards this renaissance derailed for pure European reasons, actually. But we are under the threat of global uncertainties in relation to with the fate of the US cycle, the so-called normalization path embraced by the Fed, or geostrategic considerations.